Welcome to the deep dive. Today, we're doing something a bit different. We're pushing aside all this stuff like, how nice the kitchen looks or the curb appeal.
Yeah, none of that today.
We're focusing just on the numbers, the spreadsheets,
hmm
getting into the financial math that really decides if a real estate investment works out or not.
Exactly. And our mission, really, for you today is simple. We want to give you a shortcut.
A shortcut.
Yeah, a shortcut to thinking like a seasoned investor. That means getting past that gut feeling or thinking a neighborhood just feels right.
Right, relying purely on the numbers.
Purely on the non-negotiable figures that actually predict performance over the long haul. Verifiable stuff.
Okay. And we've looked at quite a bit of research on this, and it seems like the pros consistently focus on, like, a core group of metrics.
That's right, a key trio. If you can get your head around these three, you're well on your way to vetting deals properly.
So today we're breaking down these three pillars: the capitalization rate,
Or cap rate.
the internal rate of return, IRR, and maybe the most basic one, cash flow.
And getting these three isn't just, nice to have. It's essential. They're like the universal language for comparing investments, any investment, really.
Okay, let's start at the beginning then. Why is it so critical to lean on math instead of, well, emotion or gut feelings? I mean, everyone starts there, right? You see a place.
You fall in love with the granite countertops.
Exactly. And suddenly the calculator part of your brain just shuts down.
And that right there is often how newer investors get into trouble. They end up overpaying.
Why? Because they're pricing in how much they like it.
Precisely. They're factoring in that subjective appeal, not the property's actual objective ability to make money. Following your instinct can lead straight to mispricing the asset. It happens all the time.
So it's the difference between a place you'd love to live in versus a financial asset that performs well. Two different things.
Totally different things. And these metrics, they take that fuzzy feeling that, oh, this is a great neighborhood vibe, and turn it into cold, hard data.
Objective data.
Objective data. And that objectivity is the key, really. It lets you compare completely different opportunities on a level playing field. A small apartment building versus an office space, or even compare real estate to something totally different like stocks.
Okay, so we need a standard way to measure things. And if we're looking at two different properties, say, in the same town, trying to compare them, where do we start?
That's where the cap rate comes in first, the capitalization rate.
Cap rate, right.
Think of it as your quick snapshot. It's mainly used to compare one income property directly against another similar one. It gives you a kind of normalized return potential, importantly, before considering any loans or financing.
Okay, before financing. Why is that part important? Why ignore the debt?
Well, we call that the unlevered return. You calculate it as if you bought the property with all cash.
Ah, okay.
This takes the specific investor's loan terms out of the equation because my loan might be very different from your loan, right? Different credit, different down payment.
Got it. So it lets you compare the property itself.
Exactly. The inherent operational strength of the asset.
Yeah.
Is it a good business on its own, regardless of how I finance it?
Okay, makes sense. So, the calculation. How do we actually figure out the cap rate?
It's straightforward. You take the net operating income, the NOI,
NOI?
and you divide it by the purchase price of the property. So NOI divided by purchase price.
Net operating income. Now that sounds important, and I bet that's where people can make mistakes, maybe overestimate their earnings. What exactly goes into calculating NOI?
Oh, absolutely.
Mhm.
You start with your potential gross income, all the rent you could collect, but then you have to subtract all the operational expenses.
Okay.
And I mean all of them.
Not just fixing a leaky faucet.
No. Critically, you need to account for vacancy times when you won't have a tenant. Usually people estimate, say, 5% or maybe 10% of potential rent lost to vacancy.
Okay.
Then property management fees, property taxes, insurance, and, crucially, reserves for capital expenditures.
Capital expenditures, like big ticket items.
Exactly. Money set aside for the inevitable big stuff. A new roof down the line, replacing the HVAC system. You have to budget for that.
So if you forget vacancy or pretend you'll never need a new water heater, your NOI is wrong, and your cap rate looks much better than it really is.
Dangerously inflated, yeah. Your final NOI needs to reflect the real sustainable income the property can likely generate each year. And investors use that final cap rate number to quickly judge deals in their local market.
How so?
Well, if most similar properties in an area are trading at, say, a 6% cap rate and you find one listed at 4%, it might mean you're potentially overpaying for the income it generates in that specific market.
But as you said, it's market dependent. What's a good cap rate in one city might be terrible in another, right? You can't compare Boise to San Francisco directly using cap rate.
Absolutely not. Because cap rate also kind of hints at risk and expectations for future growth.
How does that work?
Well, think about it. In a really hot, expensive market, maybe a big coastal city investors might accept a lower cap rate, maybe 4% or 5%,
Why would they do that?
because they're betting heavily on appreciation. They expect the property value itself to shoot up over time. But in a more stable, maybe slower-growing Midwest market, investors need their return to come from the rent. So they'll demand a higher cap rate, maybe 7%, 8%, or even more, because they aren't counting on massive appreciation gains. The local market really sets the bar.
Okay, so cap rate. Great for comparing similar properties nearby, tells you about the current income health, ignores debt, but it doesn't tell you much about long-term growth or, crucially, the time value of money.
Correct. It's a snapshot in time.
So if I want to compare that rental property, not just to another rental, but maybe to putting my money in the stock market or a different kind of investment altogether, cap rate won't do that.
Exactly. That's when you need the next level up, the more comprehensive metric,
Yeah.
the internal rate of return, IRR.
IRR. Okay, this one sometimes sounds a bit academic or, intimidating. What's it actually telling us?
At its core, IRR is measuring the total return of your investment, annualized, over the entire time you expect to hold it. It's what we sometimes call a life cycle metric.
Life cycle, meaning from purchase to sale.
Purchase to sale, exactly. It tries to answer, if I buy this, collect rent each year, maybe deal with some costs, and then sell it in, say, 10 years for a profit, what's my average annual percentage return over that whole decade?
Okay, so it bundles everything together, the yearly income and the big payout when you eventually sell.
Yes. And crucially, this is the really powerful part. IRR accounts for the time value of money.
Meaning a dollar today is worth more than a dollar in the future.
Precisely. IRR doesn't just add up all the profits. It uses what's called discounted cash flow analysis. It figures out what those future dollars, and from rent and the final sale, are actually worth in today's dollars. That discounting process is what makes the comparison accurate over time.
Ah, okay, and that's what makes it the universal comparison tool.
That's it. Because it considers time and all cash flows in and out, you can genuinely compare an investment property's projected IRR, say 12%, against anything else. A tech stock, a bond fund, starting a business, whatever other options you have for your capital. It puts everything on the same playing field.
It boils down all those moving parts, the initial cost, the yearly cash, the final sale price, even taxes sometimes into one single percentage rate of return.
One comprehensive number reflecting the total expected performance.
Okay, but let me push back on this a bit. If IRR is so great and captures the whole picture over the whole timeline, why even bother with cap rate? Doesn't IRR make cap rate kind of redundant?
That's a really sharp question.
Uh-huh.
And no, they aren't redundant. They answer different, fundamentally different questions.
Oh, so?
Cap rate is quick. It's based on current numbers, requires very few assumptions about the future. It tells you about the asset's health right now. IRR, on the other hand, is heavily dependent on projections. What will rents be in 5 years? What will the market be like when I sell in 10 years? What will the sale price be? These are educated guesses.
Ah, I see. So cap rate is grounded in today's reality, telling you if the current price makes sense based on current income.
Right. Are you overpaying today?
And IRR is about the future potential, justifying the risk based on your forecast of growth and eventual sale.
You've got it. You use the cap rate for that initial reality check to ground your valuation. Then you use the IRR to model the long-term potential and see if the projected overall return justifies the risk and the weight. You really need both.
Okay, let's make this concrete, maybe an example.
Sure. Let's say you have DLA. It's maybe an apartment in a trendy urban area. The cap rate is pretty low, maybe 4.5%. Not great income right now.
Okay.
But it's in a neighborhood that's rapidly gentrifying.
Yeah.
You project significant appreciation, meaning the property value itself could double in, say, 7 years.
Right. Low income now, big potential payout later.
Exactly. Then you have deal B, a stable, maybe slightly older, multifamily property in a steady suburb. The cap rate is much higher, say 8%. It throws off good cash right away.
Nice monthly income?
Yeah, but maybe there's not much happening in that area. You don't expect property values to rise much faster than inflation. Low appreciation potential.
So high income now, but maybe not a huge gain at sale.
Perfect. The IRR calculation is designed to take those two very different profiles, low cash high growth versus high cash low growth, and synthesize them. It factors in the timing and amount of all the cash flows and tells you mathematically which deal is projected to be more profitable overall on an annualized basis across the entire holding period.
That definitely clears things up about comparing total profitability, but neither cap rate nor IRR directly tells me if I can actually, pay the mortgage next month.
Ah, yes. The practical reality.
Which brings us nicely to our third key metric, cash flow.
Cash flow. Probably the most intuitive one, but still critical. Simply put, it's the actual cash left in your pocket after you've paid all the bills for the month or year.
And all the bills here includes not just the operating expenses we talked about for NOI,
Right, like taxes, insurance, repairs.
but also the mortgage payment, right? Principal and interest.
Absolutely. Cash flow is calculated after debt service. So it's gross income minus vacancy minus operating expenses like taxes, insurance, management, repairs, reserves, and minus PITI principal, interest, taxes, and insurance on your loan. What's left over is your cash flow.
And its main job, what does it do for the investor?
Its immediate function is stability, safety, flexibility.
How so?
We often call positive cash flow the shock absorber for your investment. While cap rate suggests if you bought well and IRR projects long-term profit, positive cash flow ensures the investment can actually survive month to month, year to year.
So if you have an unexpected vacancy or a big repair bill pops up,
The positive cash flow from the property itself can cover it, hopefully. You don't have to reach into your personal savings to keep the investment afloat. It sustains itself.
it keeps the ship sailing even if you hit some slightly rough water.
That's a great way to put it. It provides that operational cushion.
So the strategic choice for an investor then becomes about balancing, right? Balancing that need for immediate, steady cash flow versus the potential for bigger long-term gains shown by the IRR.
That is probably the core strategic balancing act in real estate. There's often a trade-off.
For example.
Well, some really aggressive growth investors might actually accept deals with zero cash flow or even slightly negative cash flow for a few years
Why on earth would they do that? Pay money out each month.
because the cap rate might still be reasonable for the market, signaling they didn't grossly overpay today, and more importantly, the projected IRR is phenomenal due to expected appreciation. They're willing to feed the property a little each month because they're banking on a massive payout when they sell later.
Okay, that's one strategy. High growth focus.
Then you have the other side, maybe more conservative investors or those focused on income stability, perhaps for retirement. They might specifically target properties with high cap rates, ensuring strong positive cash flow right from day one.
Even if the area doesn't have huge growth potential.
Exactly. They might accept a lower overall IRR because their primary goal is that reliable monthly income and the safety net it provides. They prioritize stability.
So chasing only cash flow might mean missing out on high growth areas and bigger long-term wealth.
Correct. You risk leaving major appreciation gains on the table.
But chasing only appreciation and ignoring cash flow could leave you vulnerable, maybe even unable to hold on to the property if things get tight or the market dips before your big payday arrives.
Precisely. You risk instability, or worse, potentially losing the property if you can't cover the costs during a downturn or a longer than expected vacancy period.
This really leads us to what feels like the most critical point of this whole discussion.
Which is,
You absolutely cannot look at just one of these numbers. Not cap rate alone, not IRR alone, not cash flow alone.
that is the single biggest mistake. The fatal flaw for so many people starting out. They latch on to one metric that looks good and ignore the others.
And they don't work in isolation, do they?
Not at all. They have to work together. They paint a picture, but you need all three parts to see the whole thing clearly. The moment you fixate on just one, you're blind to potential risks.
Can you give an example of how that might go wrong?
Sure. Imagine a property boasts an incredibly high cap rate, maybe 10%. Looks amazing on paper, right? Great income potential today.
Sounds good so far.
But maybe it's in a town where the main employer just announced they're leaving. The local economy is about to tank. So your projected appreciation is zero or even negative. The long-term IRR could be dreadful, even if the cap rate looks good now.
Okay, so high cap rate, terrible IRR. What about another way?
Okay, maybe you find a deal with fantastic positive cash flow. You're getting a nice check every single month. Feels great,
Yeah.
very secure.
Who wouldn't want that?
But perhaps the cap rate on the deal was extremely low, like 3%. That might indicate you paid way too much for the property relative to its income. So even though it cash flows nicely, if you ever need to sell, especially quickly, you might find it impossible to even get your initial investment back, let alone make a profit. The market might not support the high price you paid.
Wow. So the cash flow felt good, but the underlying valuation based on cap rate was weak, hiding a potential loss at sale.
Exactly. Each metric checks something different. Cap rate checks your purchase price against current income. IRR checks your total return against other opportunities over time. Cash flow checks your operational stability month to month.
So the big takeaway for you, the listener, is really a commitment, isn't it?
It has to be.
Commit to analyzing every potential deal using all three metrics. Run the cap rate, project the IRR, verify the cash flow. Do it before you even think about making an offer.
That interconnected analysis, understanding how they relate and what each tells you, that is the shortcut to thinking like a pro. It moves you from just being someone who hopes a property will do well.
To someone who calculates the probability and understands the risks. A capital allocator.
Well said.
Well, this has been, I think, a really essential rundown on moving from gut feelings to solid calculations in real estate investing. Thanks for walking us through these crucial numbers.
Yeah, to do it, getting these fundamentals down is key.
So maybe a final thought for you to consider as you start applying this.
Okay.
Think about how the big picture might change things. How would a major economic shift, like a deep recession versus a period of high inflation, make a professional investor maybe lean more heavily on one of these metrics versus the others?
Ooh, that's a great question. Which metric becomes your primary focus, your main shield, when the market weather changes drastically?
Right.
Risk versus return versus stability. How do you rebalance?
Something to definitely mull over. Because the strategic use of this math is the next layer, isn't it?
Absolutely.
We'll definitely keep building on these core investing ideas in future deep dives. Until then, keep crunching those numbers.